Thanks, Homer. Thanks for having me. Thanks for the intro. And I appreciate everybody here being here and spending a little bit of your evening with us. So basically, a little bit more about my background is I've spent the last 2 decades trading options, the last decade plus trading VIX futures contracts. But prior to that, I was also a commercial real estate developer. So I have a background as an entrepreneur. Um, Owned a commercial real estate development company in Charleston, South Carolina before the great financial crisis. Also owned some restaurants and an internet service provider. And so going through the great financial crisis of 2008 and seeing liquidity dry up around the world, the pain of that kind of event made me really start to think about, is there a way to kind of hedge entrepreneurial risk? A lot of people don't think there is, but I thought maybe we could find a solution. So part of that thinking was, if I had some sort of instrument that could provide a convex cash return, and by convexity, it's like a accelerating curve of a return, right when I needed it most, it meant I could take a little bit more risk as an entrepreneur. And then if a sell-off happens like 2008, then hopefully I had a nice cash position that then I could use that cash to make payroll, buy up my competitors for pennies on the dollar, or potentially buy more real estate on the cheap in those scenarios, which would give me a nice competitive advantage, but also help me compound wealth better over time. So I spent the better part of the last 10 years trying to figure this out. And as I said, I knew how to trade options and VIX futures, but I was also tracking a lot of the same managers doing similar things in the space. My partner, Taylor Pearson, and I came together about 3 or 4 years ago. Taylor was also looking to invest in long volatility and tail risk strategies. And so I showed him that using an ensemble approach to long volatility tail risk can cover more path dependencies and make sure you try to capture that sell-off. So we got together to try to build a business out of it. And one of the problems that we ran into is we had family and friends that would ask us, I've read a Nassim Taleb book or read a Chris Cole white paper. I'm worried about a black swan event. What can I do about it? And we're like, do you have $100 million? No? Well, there's not a whole lot you can do because that's what the institutional hedge funds are looking for. They're looking for large ticket sizes. So we had to figure there had to be a better way. So we figured out a process of creating a commodity pool operation that allows us to invest in an ensemble approach of managers in long volatility and tail risk, but also in aggregate, it allows us to manage a lot of money that then allows us to place those funds with those managers and allows accredited retail investors access to these kind of products starting at $100,000. So this is what we set about doing with Mutiny Fund. We launched about a year ago. And our flagship fund was this long volatility and tail risk. But I'd like to get into a little bit of why long volatility and tail risk. Like, what is the context one would need for long volatility tail risk, and why should we invest in something like that? So if I'll share my screen here. So this is basically what we work on is what we call our cockroach portfolio, or cockroach manifesto. The idea behind our cockroach manifesto is that we want to build a portfolio that's like a cockroach, right? It can survive anything. We think about building multi-generational wealth for our families. And so we want something that can outlive us and hopefully outlive our grandchildren. So the idea around cockroaches, you've been lied to by the investing industry, right? They've taught you that your savings are really investments. And then because they're investments, they help you take imprudent risk with your savings. But we think about it's savings, and you need your savings to be there when you need them the most. So part of this idea about investments is they say invest in the stock market for the long run. But part of that issue with investing for the long run is on average across everybody that invests in the stock market over the long run, they'll all be okay. But that's in average of the aggregate investors. But what really matters is your life cycle of your investing cycle. And so can you handle one of these underwater periods that last, a decade plus, or sometimes 25 years if we go back to the 30s and 40s? And see how none of us know what the future looks like. Just investing in stocks for the long run may be very imprudent for our portfolio construction, because you never know if you're going to need your savings, next year, 10 years, or 30 years from now. So what happens is a lot of people advise you to have a diversified portfolio. And usually this is what they show as the whole pieces of the pie, but we view this as just half of the pie of an investing process. So most people are going to recommend stocks, bonds, real estate, private equity, or venture capital. But all those at the end of the day are the same thing. They're all long GDP. As long as the economy is ripping higher and there's a lot of liquidity in the markets and the good times are rolling, all of these things do well. But as soon as there's a sell-off like 2008 or March 2020, which we'd call a liquidity event, the correlations go to 1, meaning all of these correlate and sell off at the same time. This is why this is only half of an investing portfolio. So we like to combine those things with what we call long volatility. We call these things implicitly short volatility because they're harmed by volatility. They want the market to stay steady and just up and to the right, but as soon as volatility takes place, all of these things go down at once. So if we pair them with the other side of the portfolio of products like long volatility, tail risk, commodity trend, gold, or potentially Bitcoin, these things help ballast the portfolio. So when the sell-offs happen, you're able to rebalance between these two asset classes of short volatility and long volatility. And this helps you compound your wealth efficiently over time and make sure your savings are there when you need them most. The other way to kind of look at how the world works is in a 4-quadrant model. The 4 quadrants are, you're always going to be in an environment that's either on the axis of growth or on inflation, right? So the 4 quadrants are you have times of growth, and then you have times of decline, you can have times of inflation or deflation. Now, sometimes we might be in 2 of these kind of buckets at the same time, but this 4-quadrant model helps us see the world through a global macro lens of these are the 4 macro environments that we could potentially be in. Now, this idea of the 4-quadrant model to handle growth, decline, inflation, and deflation has a long intellectual history. Like if we go back to the Talmud recommended that you be a third each in business, real estate, and cash reserves, trying to get that effective diversification. But we really feel the seminal piece of work was done by Harry Brown in the 1970s with his permanent portfolio, where he recommended holding equal amounts of stocks, bonds, gold, and cash to be able to manage that growth, decline, inflation, and deflation. We had more modern versions from Ray Dalio's interpretation of basically the permanent portfolios. He leveraged up the bond side. That's why they called it risk parity, because they were leveraged to equal out the same risk weights. And more modern things, we had like Med Faber's Trinity portfolio and Chris Cole from Artemis's great portfolio on the Dragon. So if we think about the different return drivers that allow for this diversification in the 4-quadrant model, for growth, we want stocks. During a decline, we want volatility or long volatility or cash-like instruments. During inflation, you want commodity trend to keep pace with that inflation. And during deflation, you want income from bond or bond-like instruments. The way we build portfolios at Mutiny Fund is we believe in ensemble approaches. We believe that creates a more robust portfolio, but more importantly, it gives us a more robust return stream where maybe we're not the highest or not the lowest, but we steady along in the middle band there, and we reduce our drawdowns. So if we were building a diverse portfolio that we call the cockroach, for the stocks, we would diversify amongst world stocks. For bonds, we would diversify amongst world bonds for that income trade. We also use more advanced trades like possibly ensemble carry trades in foreign currencies or corporate bond strategy. But then on the volatility side, I'll get into a little bit is how we build a volatility portfolio. And then if you're looking for commodity trend managers that are trading commodities, both long and short, you want different look back horizons. You want ones that use short look backs that are much faster to medium and then longer term, because there's a large dispersion among commodity trend managers of what their returns look like. And it really depends on kind of the path dependency of a recession or an inflationary period, how well there's going to do over what time frame. Now, when we think about multi-generational wealth, this is the liquid portfolio that we think about managing your savings or your investments. But what can really destroy multi-generational wealth is these exogenous events like war, confiscation, or flight, exodus. And so we feel it's important, along with this portfolio, to hold a piece of physical segregated gold, which we allocate 20% of our portfolio to manage in case there's anything that happens to the actual financial markets. That gold should provide a nice ballast and should run up in value, which would hopefully maintain your purchase power parity over multiple generations. These are just kind of generalized returns where we back tested back to 1990 what this overall cockroach portfolio would look like. These are the constituent parts, and it shows how this is a log scale, shows how cockroach outperforms the constituent parts. The important piece, though, is if we break it into 5-year segments, is the cockroach portfolio always chugs along, and it's usually one of the best performers in each of those 5 years, but never the worst performer. And that's kind of the point, because you never know when you're going to need your savings most. We want to make sure they're there when you need them most. So this also just gives an idea of the return streams. The worst year being for this hypothetical back test was down just less than 6% in 2015. So it just gives you a general idea of how we think about the world of portfolio construction. So that way I can get into how we manage at least this volatility portfolio. While I'm pulling that up, just in case Homer wants to interject, sometimes I miss a lot of things. So
Yeah, I know. I guess what I'd want to interject or ask here is, you know, and part of what we're going to talk about with the long volatility specific component is, that this could and should be part of a long-term view of your portfolio. But maybe there is a reason though why now makes sense though to be looking at something like this. Partly we talked about it in the first session, but maybe partly why these types of things haven't been available previous to this. But we can talk about that a little bit later when you get into the ensemble approach. But why now for long volatility? Maybe we've talked about death of the 60-40 in a previous interview and other things, but why should we be thinking about this in particular right now?
great question. So if we think about the 60-40, there's kind of two pieces or two viewpoints to look at it. Most people, we're really using 60-40 to reduce our exposure to stocks, because in a 60-40 portfolio, over 90% of the risk is actually on the stock side. And the bonds don't provide that much of a balance to the risk side of the equation. So you're just reducing your exposure from 100% down to 60% in stocks. Now, the other piece, and I'll show a chart when we're going through this, is that we've had this amazing bull run in stocks and bonds for the last 40 years. But if we back test, going back 120 years plus, there's a long periods where stocks and bonds are correlated. So especially in like inflationary environments, like the 60s and 70s, you can have stocks sell off at the same times as bonds sell off. So we wouldn't have that negative correlation that we've had for the last 30 to 40 years. The other thing is, so if we think about bonds, is that for the last 30, 40 years, we've come down from 16% down to almost zero. And so as those go down, that just increases the actual price component of the bond side. So now that we're at the zero bound, there's not a lot of tools left for the Fed to cut rates. And if they do, there's not a lot of asymmetry in that payout to really ballast as stocks are selling off. So that's one way we look at the new 60-40 is if you combine stocks with something that's structurally negatively correlated, like long volatility or tail risk, it'll be there when you need it most when you have a sell-off on the stock side. And so if you can build structural negative correlation into a portfolio, and then you rebalance frequently, that helps you compound your wealth efficiently while reducing the drawdowns. And so we've just been really lucky in the last 30, 40 years to have a little bit of this negative correlation between stocks and bonds, but we're not sure you can count on that moving forward.
Yeah, and part of our interest, for our team in doing a lot of this research is, we've been feeling similarly in that, I've been in the business now 20 years, and that 60-40 portfolio has been a pretty excellent, just risk reward type portfolio. But we've been seeing enough events. 0809 was one of them, obviously, but even recently with the December 2018 and March of 2020, we're just seeing these events that are making us feel like there's just some potential shifts coming in the markets. And as we looked at all of the things available out there for this is where Dave and I initially really discovered this whole concept of long volatility. We weren't really we hadn't really seen much on it ourselves, as we'll get into the whys of that a little bit later, but it wasn't something that was really available to retail investors and retail advisors like ourselves. And so we were just really excited that, hey, there looks like there might be something out there that if we believe things are shifting and that the markets may not work the same way that they've worked for the last 40 years, we need to have something in our portfolios that can protect for that. So that's really, I probably should have said at the very beginning, but that the whole why of Mutiny and from our point of view is that we just see the winds changing a little bit, and we want to make sure that we're doing our job to look at the full spectrum of diversification, like Jason was talking about in the cockroach part of the presentation, of just what works over time and what real diversification is really all about. So with that, I'll turn it back over to you, Jason.
Great, thanks. Yeah, I should touch on too is that I've been building these holistic portfolios for the better part of 2 decades now. And part of the problem is that, I build these portfolios for myself, for my family, for my in-laws. So my partner and I, we have both ourselves, our families, and our in-laws in these funds. So we're trying to build this robust portfolio construction that can manage any macroeconomic environment. And the piece that was always missing for retail access was this long volatility and tail risk. So that's why we felt it was imperative for us to be the first ones to actually bring a product like this for market for retail clients to have access to. So this is that's the impetus really for Mutiny Fund. So, as Homer was referencing, this gives us an idea going back to Black Monday in 87, some of the worst drawdowns we've seen. And then thinking about even 60/40, 60/40 had a 33% drawdown in the GFC. Also, if you would test it back to the 1930s, it would have had a 63% drawdown. So it gives you an idea of kind of, drawdowns are what really hurt your compounded returns over the long run. So it's a volatility tax. So if you can reduce those drawdowns, you can really improve your compounding your wealth over the long term. This gives you an idea like that is this middle part is if you take away the 10% of the largest losses on the S&P, this is how you would increase your wealth over time, and subsequently the 20%, and then this is 30%. So it gives you an idea if you can really cut off those tails on the left side, you can really manage to compound your wealth better over the long term, but more importantly, you can sleep at night. And I'm not sure that, bonds provide that ballast anymore. So an effective diversifier, I brought up this idea of structural negative correlation, meaning, if stocks go up, this might go down slightly. If stocks go down, this might go up a lot. And if you're rebalancing these two asset classes that zig and zag in a negative correlated fashion, you can then rebalance to compound your wealth over the long term. That's this teal colored arrow here. So how do we diversify, right? And this is the problem with diversification. And this is what I showed in the cockroach slide as well, is about, everything that tends to be correlated in a sell-off. So, this is what happened in 2008 to different asset classes outside of US stocks. To give you an idea, they didn't quite provide the ballast to your portfolio that you would have needed. This is what we referenced earlier about the bond charts. This is a comparison of the correlations between stocks and bonds going back to the 1880s. And you see that the red line means that stocks and bonds have ended up being correlated much more time than they've been uncorrelated. They've actually been positively correlated 89% of the months going back to 1883. And we've just been in this unique period of uncorrelation or negative correlation between the two. And we're not so certain that will happen in the future. And also stocks and bonds tend to be more correlated during inflationary times. Another ballast for a portfolio or a hedge is gold. And we like gold. We have no problem with gold. And I think gold has amazing, 3,000-year history of really providing a good, alternative to portfolios. The problem is during those intervening periods, any given month or quarter or year, gold may not be that risk off asset you're looking for. And that's what this is showing during some of these drawdowns. Gold has not provided that ballast that we're looking for. And what happens is when, all these other asset classes sell off, like in March of 2020, people don't want to sell their gold, but they have to sell their gold to raise cash. So this is why in a very acute time frame, gold may not be that tail risk hedge you're looking for. This is going back to like when people show you that pie chart. On the left here, these are all the different asset classes. But on the right, what we're saying is all these different asset classes that think are diversified, they're actually implicitly short volatility, meaning they're harmed by volatility. And most portfolios then end up being predominantly short volatility with maybe only a tiny bit of long volatility. We want to kind of rejigger that balance to provide you more long volatility protection, because we think rebalancing short volatility and long volatility is what helps you compound your wealth. And like I said, sleep at night. So then we come to the VIX. So what is the VIX index? VIX is colloquially called the fear index. And the idea is the VIX is predominantly negatively correlated with the S&P. So when the S&P sells off, the VIX spikes. So the VIX is a great hedge for a portfolio, and it is a great fear index. All of these tops in the VIX are when we've had sell-offs in the S&P. So if we could combine the S&P with the VIX, we would have a nice negatively correlated product. The problem is the VIX index that we're showing here is non-tradable. And what they did is they created the index, so then they created a futures market that's tied to that index. And part of the futures market is we have a term structure, which just means, at all the subsequent months of the contract end up being more expensive than the front month. And what happens is the curve will roll down as we come closer and closer to the actual date that we're trading. And so therefore there's a headwind or a roll yield in VIX. So if you're able to go long VIX, you actually have this bleed that's part of the term structure of the futures contract. So if you could actually trade the VIX index without this term structure, it'd be a great hedge, but you can't trade it. There's a term structure to that VIX contract. And so what that ends up looking like is this. If you were to go long the VIX, from 2012 to to 2020, before we had the sell-off, you would have lost 99% of your portfolio value. And the problem with that is you don't want to keep betting on the sell-off to happen, and then the sell-off doesn't come and you've missed out on that runoff in stocks. So it's really about a proper portfolio construction that has these negatively correlated assets. You don't want to be too much on either side. So how can we prudently diversify? You want a dynamic long volatility and tail risk strategy that doesn't bleed out. So how do we do that? We created the Mutiny Fund because we think it's true diversification to black swan protection through long volatility exposure and high level of convexities. And we're trying to reduce or eliminate that bleed over the entire business cycle. And what do I mean by that? We could have intervening quarters or years where we might be down, but from a risk on cycle from 2009 to 2020, over that entire cycle, we want to be flat to slightly positive on our carry. That way you're willing to hold this risk off asset. So when we think about the construction of our portfolio, we have to think about these three pieces and how they interact with each other, both convexity, certainty, and carry. So when I talk about convexity, the difference between convexity is like if you have a linear instrument, it just keeps going up in a straight line, like one for one. So if the S&P sold off 20%, a linear instrument would be up 20%. If the S&P sold off 50%, a linear instrument would be up 50%. A convex instrument is just that acceleration in the curvature, and that's what you get out of options contracts. So in a convex instrument, let's say the S&P sells off 20%, maybe it's up 20%. But if the S&P sells off 50%, a convex instrument may be up 80 to 120%. That's the convexity. It accelerates into that drawdown in the S&P, and those are the kinds of instruments we're looking for. So the issue with buying those convex instruments like options is you have to pay a premium. It's like an insurance premium to hold those options. So you know what that insurance premium costs you, which is a bleed, but you have an unknown upside and a very convex upside to those positions. And if you're just buying options and you permanently put them on, you have a bit of certainty there. But the more convexity you have and the more certainty, maybe the worse your carry is, right? And so if you want to improve your carry, you want to be flat to slightly positive, you may have less certainty or less convexity. And so there's a lot of trade-offs in this triumvirate, and that's why we try to use an ensemble approach to this to try to find the best fit for our portfolios. When we're thinking about long volatility, this is kind of the returns of the S&P here on the left. And part of long volatility is not only do we buy options on the left tail or put options, or we're long put options. So if the market sells off, we have a nice return. We also buy calls on the S&P 500, deep out of the money calls. So if the market melts up, like a 1999 scenario, we want to make a little bit of money there too to help cash in on those melt ups before there's a crash. So this is kind of the return profile that would be ideal, is in that melt up scenario, you want to make a little money. In slightly up markets, flat markets, or slightly down, we're going to lose money. And then this is where that convexity kicks in, is where the larger the drawdown is, the more money we want to make. The other way we look at it is anything less than a negative 10% sell-off in the S&P, we view as just noise. If you tried to cover that move, it would be prohibitively expensive and the bleed would be enormously high. About a negative 20% sell-off, that's where we feel most people tend to capitulate or the fear really kicks in. We hope to match that negative 20% sell-off about one for one. I say we hope to because you can never be certain, and this is why we believe in an ensemble approach. But then if the market sells off 40%, we expect to be up 60+%. And that's where we see that acceleration of the convexity kick in to really cover those deep sell-offs in the S&P 500. So how do we build this? The primary way we like to look at it is we like to buy options. Because as I said, when you're buying options, you have to pay up that premium or that little bit of bleed to buy an option, but you have an unknown upside. So in that sell-off, you have huge amounts of convexity. So when you're just buying options, you know exactly what that premium bleed is. So you cannot blow up if you're buying options. It's maybe a death by 1,000 cuts. So this is why the bulk of our portfolio is just buying options. The problem when you're buying options is what can happen in a March like 2020 like sell-off. As the market sells off, those options become, they really become rich and are kicking in for you. But if you go to roll those to buy more options, now that premium is going to be higher because there's a lot of fear in the market. So what we want to do in that scenario, we also want to have a bucket that trades short futures. And all that means is we use the futures indices for the S&P 500 to just go short the S&P 500. It's just a directionally short trade where you don't have to pay up for the premium of the options. So it's much more of a linear trade in that sense. but you can directionally short the S&P 500 instead of paying up for the premium in that scenario, which adds a nice wrinkle to the portfolio to go along with our options. The other primary piece of our portfolio is we call dynamic VIX. So the other part where options get hurt, like I was saying, is you're paying that bleed. So during a risk on cycle, you might have a lot of premium to pay over those years. So we want to try to reduce that bleed. So we use what's called a dynamics VIX strategy. And what that means is it's primarily a pairs trade between the VIX and the S&P. And like most pairs trades, like when you're long Coke and short Pepsi, you're doing that as a form of arbitrage where it's a form of income trade. So this is why we really like the dynamics VIX trade, is that hopefully garners a little bit of income during that risk on cycle that helps pay for the bleed from the option premium. But what's really nice about dynamics VIX strategies and this pairs trade is our managers can make a market neutral trade. But if VIX spikes, they can be long that front month VIX, and they can really also capture a little bit of that sell off too. So it's a nice way to play a market neutrals pairs trade. Now, those are three very active buckets that I was talking about. And we use an ensemble of managers in each because we're trying to cover a lot of path dependencies. And those managers may only be in the market 40 to 70% of the time if they're trying to algorithmically time these sell-offs. So if we think about like a forest fire, they're looking for humidity levels, undergrowth below the trees, wind conditions, previous fires. They're looking for a time when it looks like we're susceptible to sell-off, and that's where they're trying to time the markets. Now, what would happen if on a Saturday or Sunday we had some sort of exogenous event like a 9/11? It's not likely to show up in their models, so they wouldn't have had the position on. So, as I said, Taylor and I have our own money in this, our family money and our in-laws. So we want to sleep at night. So what we decided to do, we feel like we can earn enough return on that risk on cycle with our other three strategies that we brought back this idea of rolling puts. And what rolling puts means is we buy deep out of the money puts on the S&P 500 index at like a negative 20% attachment point, which means if the index sells off negative 20%, these puts will cover that sell-off. And because they're permanently on and we're permanently rolling these puts, it's a permanent negative carry until you have that sell-off. But we feel with the other parts of our portfolio, it helps us pay for those puts, and we want to have those on so we can sleep at night. So that's kind of the four primary path dependencies that we built the long volatility and tail risk around. So in general, this chart once again shows, like on the left side is the returns of the S&P, anywhere from up 25 to down 35. The darker gray parts or teal parts is where we expect to make a lot of money. The lighter parts are where we expect to not make money or potentially lose a little bit of money. So as I said before, we're uninterested in flat or slightly up or slightly down markets. We're trying to really make money here when the market sells off, especially in acute fashion, and a little bit longer term, we should do okay as well. But we're also looking to also make a little bit of money if the market melts up. So this is this gives you a kind of a different target of how the different strategies pay off. And this is what I'm saying. We use all these strategies and all these managers to try to cover as many of those path dependencies as we can, because we know what like the 2008 sell-off looked like. We know what Black Monday on 1987 looked like. We know what March 2020 looked like now. But as we didn't know prior to March 2020, we didn't know what a COVID-like sell-off would look like. In the extreme rapidity of that sell-off, it was the fastest sell-off in market history. So we never know what the next sell-off is going to look like. So we try to cover as many path dependencies as possible. And we're invested in over 13 managers implementing their niche strategies. So we expect there may be 3 or 4 of our managers that actually miss that sell-off. This is why we believe in the ensemble approach, because we want to make sure the bulk of our managers capture that move and we're able to monetize that sell-off.
I think it's, I just want to point out
Yeah.
one thing here, good timing for that slide. Actually the one that you just had up, all the managers, as we were researching this and identifying how can we bring some of these ideas to the table, and kind of playing off something that Jason mentioned earlier, the first real research we saw on this was a paper called The Allegory of the Hawk and Serpent by Chris Cole at Artemis, and this whole concept of the dragon portfolio was in that paper. And we reached out to his team, Chris's team at Artemis. It was pretty soon after the March crash, as we were interested to see what would it take to get access to some of that. And the reality at the time was, number one, that the minimums to get into there were like $1 million or more, maybe 2 million to get into the Artemis fund just for one single investor. And they had no slots available. And that's pretty much the case, especially at that timing, right after the crash. Probably all of these managers pretty much were full and had no slots available. So the ability to build that portfolio that Jason just walked you all through with all those different strategies to protect a portfolio, to do that on your own would be, require, to Jason's point, maybe as much as $100 million just for the long volatility piece to get access to all of these managers. And so it's, as we were researching in some of these other ones, that's thankfully how we found Jason and what him and Taylor were putting together to really bring a new offering to the table that wasn't available before, to get this at a place where we could invite our retail clients into this, and have it at a level that wouldn't be too much of their portfolio in any one thing as well. So I just wanted to emphasize that this is a new, up until literally April of last year when they launched this fund. Again, unless you were 100 million or more in assets, you just didn't have the ability to access these. And in general, the VIX itself has only been tradable for 10 years ish itself anyway. And so Jason was one of the pioneers of figuring out how to trade around that as well. And so it really is a unique offering. And because I don't know if in your mind you're on, why are we just hearing about this now, or why wasn't this available before? It really is something that is really brand new. And I would say, we're, of other investment advisors out there, very few of them are looking at this space right now. Hopefully more will be. I'm sure Jason would like more of us to be interested in this space, but it's definitely something that Dave and Melissa and I really believe is important to at least consider looking into, just due to the nature of the changing environment what they're in. So anyway, with that, I'll turn it back over to you, Jason. But I thought that was important to point out, that it's just what Jason's built. Again, it's very difficult to replicate what he's created.
Thanks, Homer. No, that's helpful. And I'm almost done, but it does make me think about, I'm friends with all these managers. I've known most of them 6, 7, 8 years. And they're all looking for $100 million checks from large institutions. That's the way they built their business. And so Taylor and I felt it was a travesty that retail wasn't provided with access to these kind of portfolios that can really help you in a sell-off when you need it most. And so we really built this, like I said, for ourselves and our families, and we didn't have the money to provide this access to these managers in an ensemble approach. But we knew if we built this at the aggregate level, it would provide access for ourselves and our families. So that's why we were more than happy to build it. So we launched primarily with this long volatility series, which was our flagship fund. And we offer monthly liquidity with our long volatility series. But for a lot of clients, it's difficult for them to maybe pair this up themselves with long volatility plus their stock and bond exposure. So what we also offered is our long volatility series, and in-house we overlay the S&P exposure using the futures market, and we're able to rebalance it monthly for our clients. And because of the structurally negatively correlated asset classes between stocks and long volatility, we view this as a superior portfolio, or this is the new version of 60/40 that we believe in. This is kind of just performance since launch. We were able to launch in April of 2017. We were really hoping for that, we're not hoping, but if there was a second or third leg down in the markets, we were really protected against that. But there, as we know, there wasn't. The market just ripped higher. And then we were able to launch our long volatility stocks in August. And then the portfolio I showed you earlier, the cockroach portfolio, is what we're working on launching now for a holistic portfolio for our friends and family. The idea behind Mutiny Fund is the concept of we want to just maximize your long-term wealth by minimizing drawdowns. But not only does it maximize your long-term wealth, if we're able to minimize drawdowns, that money can be there when you need it most. We don't know when you're ever going to need it. If you have a family member get sick or unexpected events, you need that money to be there a year from now, 10 years from now, or 50 years from now. The other way we try to maintain this long volatility fund is providing those large asymmetric gains in periods of high volatility or tail risk, when you need them most, when everybody is, fear kicks in and nobody knows what to do, everybody's panicking. This can give you really that calmness or that serenity of mind right when you need it most. And that truly negatively correlated effective diversification helps you sleep at night. We protect against those market crashes through an ensemble approach to long volatility, and we provide this easy access to monthly liquidity, and we have no lockups. We're not interested in that. we hope you use this as an ATM. If the market sells off and we have high returns, we want you to be able to rebalance that with your other exposures to stocks, bonds, real estate, et cetera.
Hey, Jason, real quick, I know
Yeah.
timing is everything in our world, and so launching in April after an event like
Yeah.
March of 2020. So I know just due to our regulatory environment, you can't speak to what the ensemble performance would have been in March, but um, speaking to some of the performance of some of the managers that you utilize, you don't have to be specific, but I mean, talk about this convexity and what happened in March with some of these long volatility managers. What did that look like in March for, Artemis or some of the other Logica, some of those funds?
Sure. A good example, like you're saying, without the regulatory constraint, is the idea in both Q1 or quarter one of 2020 and March of 2020. They look very similar in the sense that for the amount the S&P was down, most managers had doubled that return. So, in March of 2020, the market was down 12%. Portfolios like this could have been up, 24%. And similarly, the market was down 20% over the entirety of Q1. And strategies like this were potentially up 40% during that period. And then more importantly, you're rebalancing the rest of your portfolio. So the idea is also, this allows you to hold more the short volatility assets like stocks and bonds and be able to sleep at night, because who was looking to buy stocks April 1st? If you had long volatility or tail risk on your books, you would have made a lot of money to balance that sell-off. But more importantly, you would have rebalanced back into your stocks at a lower point, which allows you to compound wealth more effectively because you're going to capture that V-shaped recovery in the stocks, and you're going to be adding money right at that low point.
Yeah, and one of the reasons that we really fell in love with this concept, and I think Jason's mentioned it earlier, this idea of the entrepreneurial put option, is a lot of our clients are business owners. And just thinking about, whether you look back at 08, 09 and March of 2020, and while for many businesses 2020 worked out okay, I think sitting at the end of March, early April, there were a lot of big question marks on what was going to happen. And knowing that you have something in your portfolio that is bringing that liquidity back when you need it the most. And sometimes it can be a hard conversation to have with business owners. By nature, you're more entrepreneurial. You want to take more risks. So even though you've got this asset sitting there that has 70, 80, 90% of your wealth in your business, the nature is you still want to be aggressive in your investment portfolio outside of your business and invest in aggressive equities and keep up with the market. And while, we're happy to invest that way, we love the idea that, hey, maybe you should consider, rather than focusing so much on the equity side of your portfolio, if you're a business owner, you might actually consider more of your liquid wealth into something that's going to be there to protect that business in these major events. So that was another reason why we really like the idea of Mutiny, beyond just protecting your investment portfolio. If you've got a private business or a significant amount of private real estate that's going to be really illiquid in these types of events. I mean, imagine trying to sell a commercial building on March 31st. I mean, it just wasn't going to happen. So anyway, I just wanted to make sure I added that point in too, is that this really goes beyond, potentially just protecting an investment portfolio. It really can be something that can protect your bigger net worth. And that's definitely something we'll want to discuss if that is important to you. So yeah, I just wanted to add that in.
Yeah, I'd love to piggyback on that, because that's exactly why we built the long volatilities, because of the pain I experienced in 2008 as an entrepreneur and a commercial real estate developer. So I think much more philosophically about where my exposures lie, about my life in general. So as an entrepreneur, business owner, real estate owner, all of my assets I'm levered long GDP already. So if I add stocks to my portfolio, I'm now leveraging myself long GDP. So for me personally, I put all my liquid net worth into our long volatility series, because that's actually what I need the most to hedge out my entrepreneurial and real estate risk. And so that's a little bit, like you said, outside the box for people to think about, but that's the way I personally think about the markets in general.
All right, good. Thank you much, Jason. And so that's kind of the end of the formal part of the presentation. We wanted to make sure we had plenty of time for questions from the audience as well. And so, Jason, clearly a smart guy with, pretty complex product here. So I want you to make sure that, yeah, there's no bad questions when it comes to diving into this subject. It's pretty complex, but also, Jason talks to a lot of people, in our industry on the macro side as well. So, you don't be afraid to ask him something. He may, he'll defer if he's not the guy to answer it, but don't hesitate to ask him anything else that you're thinking about when it comes to the bigger picture of the markets as well.
Who's going to be the courageous first one?
Come on, Al, I know you got something there. You got to have a question. Ed, come on. No, I know you got to have a question.
We're going to make sure Dave knows all of this, so we're going to check in with him.
Yes. Yeah. Dave and I have been doing a lot of talking with Jason. I think this is probably our fourth or fifth either interview / presentation with him on this stuff, in addition to lots of additional reading and listening that we've been doing. So it's definitely a hobby that Dave and I have taken on, in addition to our normal day-to-day management, to really learn and kind of fall in love with the idea of what long volatility can bring to a portfolio. So you'll definitely be hearing more from Dave on this for sure. Hey, Ed.
Hey, guys. So Jason, not so much a question as a request to just repeat, if you would, that last section on why someone that has most of their net worth in a business and or real estate might want more than a dabbling amount in this. You said you have most of your liquid net worth in this because of your business owner status. Could you just repeat that, the logic of that?
Sure. It's good to see you, Ed, by the way. So the way I think about it is, like, if we go into the great financial crisis of 2008, right? And if I own real estate, whether it's residential real estate, commercial real estate, et cetera, or I have a business, I'm basically long GDP. I'm harmed by volatility. Meaning, if I have a real estate project or a business project, I'm usually thinking 3 to 5 years out, right? I'm going to put in a lot of sweat equity now, and I need the future to look like the present. If volatility comes into the marketplace, I may not be able to make my numbers work 3 to 5 years hence. So that makes it very difficult for me to predict as an entrepreneur to build the things I need to build. And so I want to reduce volatility exposure. So if I'm working on a real estate project, or I own real estate, or I have a business, when the good times are going, when we're in a risk on environment, we all know what it looks like. Rates come down, there's a wash in liquidity, we can borrow tons of money, we can build our business, we can hire, everything looks great. So at that point, if I have anything left over that I can't put back into my business, and I have some liquid savings, and that's why I'm always considered to call them savings instead of investments, because I need them to be there when I need them most, is if I put those savings into the stock market, I'm now doubling up my leverage or tripling my leverage to the stock market, because my real estate holdings, my business, are both tied to what's going on in the stock market, because all three are long GDP. They're all harmed by volatility. When liquidity dries up globally and the markets crash, they're all going down together. And so that is a very fearful condition. And I know what it's like to be in the fetal position on the floor in 2008, because you don't know what you're going to do. And so to me, if I can't help myself, I'm going to be an entrepreneur. I'm going to build businesses. I'm going to buy real estate. I'm going to own things. And so if I can hedge out some of that liquidity risk by holding long volatility and tail risk that will provide me this convex cash position right when I need it most, it allows me to have much more confidence in myself as an entrepreneur, because I'm not worried about the exogenous market risks. And so therefore, the event happens, I have this long volatility tail risk, I'm sitting on a pile of cash, I can now make payroll, I can buy up my competitors, I can buy more real estate for pennies on the dollar. But more importantly, I can sleep at night and I don't make stupid decisions based on fear, because I have peace of mind now. And that provides me a tremendous advantage, a competitive advantage. Like, to me, it's a superpower. For an entrepreneur to have this kind of macro hedge, it means they can push harder than all of their competitors in their space.
Beautiful. Thank you.
All right. Well, if there are no more questions, I appreciate everyone joining today. We're also going to be doing a recording of this. So if you need a refresher, see it again, let me know. We'll be able to send you out a link. We'll be sending it out to those that we had a few people who couldn't make it this evening or over lunch today. So we'll be getting it out. But we'll also for all of you who have some interest and liked what you heard today and are interested in learning more, definitely reach out to the team and your primary advisor. And we're kind of gearing up to be ready to go into this. I do think, interesting timing in the world, and, don't have a crystal ball, but I kind of had a sense that the first part of this year would have a lot of tailwinds to the market. And, we're kind of sensing that the second part of the year a lot of those may shift. So that I do think the timing is probably pretty good to be considering something like this, just where we're at and everything. So yeah, we'll definitely be reaching out to follow up and see if this is something that makes sense for all of you. So with that, I just want to thank Jason again for taking his time today, and for all of you to come on in and learn a bit more about long volatility. And it's pretty complex, but I think pretty important strategy that we're going to be discussing with all of you here in the coming weeks and months. So with that, have a great evening, and we'll see you all very soon.
Thanks, everybody. Appreciate it.